Are you looking to simplify your investments? Check out BMO ETFs. Your asset allocation can have a major impact on whether you will meet your financial goals, so it's no wonder Canadian investors are turning to asset allocation ETFs to complement their portfolios. BMO offers easy-to-use solutions such as the BMO Growth ETF, BMO Balanced ETF, BMO All-Equity ETF, and more. These ETFs invest in a number of underlying index-based ETFs and are rebalanced automatically. What was once a popular mutual fund strategy is now available through an ETF with the introduction of the T6 units. T6 units provide a 6% annual payout on a monthly basis, helping retirees meet their cash flow needs. This is available on their balanced and growth asset allocation ETFs. Regular rebalancing means you can spend less time planning your life and more time living it. Learn more at bmoetfs.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 89. As always, joined by the three amigos. We got Rich Diaz, Acorn Macro Consulting, and back in his UK flat there, and Keith Dicker of IceCap Asset Management. Boomer with the Patagucci hat on a vacation. Where are you?
Yeah, I'm in Moab, Utah right now. Going around with Junior. We're crawling around all the canyons, lock canyons, biking, and all that stuff. And if you've ever been to Moab before, it's the exact opposite of Rich's Flat and Kitsilano. Moab is, you guys wouldn't survive here that well. But to give you an idea what it's like, you can't see it, but I have a t-shirt on here, kind of Moab. But it's a picture of Bigfoot riding a unicorn with a UFO beaming him up. And I think that says everything you need to know about Moab.
So there's a lot of conspiracy theories over there. You'll fit right in.
Actually, guys, if you ever have a chance to come to Moab, anywhere in Utah to go hiking and stuff, it is beautiful. It is just stunning how nice it is here. And everyone's here for like a adventure tourism. At 5 a.m., everyone's up and about to get going because you got to beat the heat. The heat is just unbelievable here right now in July. But that's the only tourism. There's nothing else going on except the Loonie Hour, right, Rich?
Right. Well, in London it's June, not July, and we also have to beat the heat here. It's too hot for London, so I've been hiding out in the office.
Is that your bottle of wine in the background?
I was going to say we're recording this on a Thursday, and it's very late, way past my bedtime. I'm having a nice little bottle of rosé from the local.
Let's see if you can finish that by the end of the episode.
Oh boy. But no, I'm good, man. It's lots of stuff going on. Yeah, beautiful. It's just really lovely. Like the weather's great, man. Sometimes
you're heading back to Montreal.
I don't know. This is material, non-public information.
No, but in general, you always go back to Montreal in the summer. So let's. We'll leave it there.
Yeah, I'll leave it there. But yeah, Montreal is in the cards regardless. But yeah, I can't wait to get back. But anyway, there you go. That's the story. Let's get into it. How are you doing? Oh, it's your shirt again. Are you wearing the same shirt as last week?
Yeah, I only have one shirt. You know, it's housing market slowing down once again, so I had to cut my shirt budget. And yeah, but no. Anyways, on the on the Vancouver event, we've had people asking. So yeah, tickets. I'm hoping if I can get my act together here on the weekend, tickets will be released for next week. So when we drop next week's podcast, my hope is that the tickets will be available. Again, it's a 300 seat venue in Vancouver. So it'll be our largest event, almost double the size of the first Vancouver event. So should be a lot of fun. That's going to be on July 27th. And like I said, anyone that's listening to the show, you guys will be the first to know. You'll know when they'll drop because I will definitely promote it. So, but yeah, that's about it. I mean, I think a pretty busy week in finance right now. I think in financial markets, you know, the inflation scare is back. Everybody's freaking out about the bond market. You know, I can get into the housing stuff, which is, you know, all the housing bears are back. Of course, the Bank of Canada raising rates, a week or two ago. And, bond yields surging back up. We've got the Canada 5-year bond yield. I think it's back to it hasn't pierced its high, which was, what was it? October. It's right.
I think so.
So the October high was 3.85%. And right now, as I'm looking at my screen, it's at 3.85. So we're right back to those October highs we've seen in the mortgage market. We had so everybody was basically, anyone that was participating in the housing market, I can tell you, everyone has basically been using 3-year fixed rate mortgages pretty much for the entirety of this year. And so, keep in mind, those were like 5.5 last year. They came down to about 4.7, sort of in the spring market of this year. People started getting excited again. Prices were accelerating higher. And now you've got your 5-year or your 3-year rate again is back to about 5.4, 5.5. So mortgage rates, long story short, are basically back to the highs of last fall. And so this is obviously setting up for what I think is going to be a material slowdown. Now, it's funny because, everybody's jumping on Twitter. This guy called the bottom. It's now going to drop out from underneath its feet. The crash is resumed. It's back on. The crash is back on. So, taking a lot of slack for that. So I'm enjoying it.
Well, I don't know. That's not what happened. That's not what the sorry, Keith, but that's not what the data from last week was. Right, it was still low supply. Right, there's still low inventory, which I guess is related to supply. And so far, people haven't been squeezed yet, as far as the great rate reset, which I think we were maybe too early to. So I trust you. I trust you, Steve. Keith.
I mean, to that point, again, I'm in Vancouver, so I can tell you, like, since January or just, really, like, the bottom of the market so far, again, could change. I don't pretend to know the future 8 months from now. But your typical detached house is up about $200,000 to $300,000 since sort of the bottom of, the fall market last year. So, and again, like I pointed this out on Twitter, right? Which is like, part of this thesis. And again, I'll be the first to admit, hey, you don't get everything right. But I was surprised, like, that the economy's still kind of holding on and the Bank of Canada is still raising rates. Like, so, again, as the data comes in, I think people should be willing to sort of change their opinions. And my opinion is like,
yes,
right? Like, my opinion is that right now, whether you're in Vancouver or you're Toronto, Calgary's at all-time record high prices. Vancouver real estate, and for the most part of Toronto, most of those markets, the prices accelerated in the spring, basically reaching the levels of where they peaked at last year in February, March, when interest rates were 2% or mortgage rates were 2%. And so now mortgage rates are not at 4.7 and falling. They're rising back up again. They're at 5.5. A lot of these 2-year mortgages are at 6%. Like, and so you got to get stress tested at basically 8%. Something is going to have to give. If rates stay at these levels, I think it's logical to conclude that prices will come down. Now, to Rich, to your point, you're asking about, like, supply and inventory. Like, that doesn't change. You're still dealing with, like, essentially 15 to 20-year lows in inventory. So you're not going to see a material price correction in the next 6 weeks. Like, this is going to take time. But it takes time depending on how the rates hold up. And so it's like, what's the Bank of Canada going to do next? And that's really, what are bond yields going to do next, which I think is going to be sort of the thesis of this week's show.
Yeah.
Keith? Well, I think it's incredible. I think Rich just touched on it, or Steve, you did. I forget which one opened the window for this, but it seems like the narrative has done a 180. It's changed very rapidly within 2 weeks, 10 days,
totally,
something like that. And what has changed really? Now all of a sudden we've gone from a period where all the central banks have, they stopped hiking. People were predicting a cut was coming up later on in the year, stuff like that. And then all of a sudden, I think the Aussies were first to hike rates, and then the Canadians did it, and the Europeans came out hawkish, and then same thing. The Fed paused, but it was a hawkish pause, as they say. And then Powell was
And
out
then-
again yesterday. Yeah.
And then
Like
today.
And again today. Yeah, I think today was the Senate. Yesterday was Congress.
No, I meant, sorry, the BOE. Excuse me. Sorry to interrupt you.
Yeah, I wasn't finished. I'm still dancing around.
Sorry,
So then you have, the Swiss, they hiked by 25, the Norwegians, and then, whatever the hell they're doing over there on, are they on Threadneedle Street? Where's the Bank of England? What street?
Yeah, that's it, I think.
Is it Threadneedle?
Yeah.
They come out with like the mad bomber today with 50. But if you put all this together, now all of a sudden we've gone from a world that went from like 0 to 3, 4, 5%, depending on where you were. And everyone paused, and we're waiting for something to happen. And the only thing that happened, that inflation has come down enough. And now all of a sudden, central banks, I talk about risk has been synchronized around the world. Here's yet another example of that, just sort of, confirming or affirming that view, that now central bank policy has once again been synchronized. Everyone is hawkish. So now we're going to have this moment coming up where, we've talked about before, something will break or it won't break. Maybe it's not in Canada, it could be somewhere else, but they are quite determined to slow down inflation. And the only way you can do that is by, slowing the economy. Now, one thing that doesn't get brought up a lot, or sometimes it does get brought up, but it's, in broken English, I guess. Even though the central banks are tightening, the fiscal side of the equation, we've had a really good conversation about that recently. That is still very stimulative. So, like, for example, the Canadians now, what do we have, 40 billion for our budget deficit, and that should be around what, 2%? That's 2% of GDP almost.
Yeah, roughly.
And
I have to check. Sorry.
Yeah. So we're a little over 2 trillion, I think, for GDP. So 40 billion. You do your math, Rich, the thing that you do.
Hey, Keith.
But fiscal stimulus, like they can't. The central banks are trying to slow things down. And meanwhile, governments are still like spending like, it's 1999 again.
Keith, I have a question for you. Do you know, so Jack Farley, with BlockFi there, he just put out, he's just cranking out, Blockworks, sorry. He's just cranking out the interviews. But he just did an interview with Michael Howe. Keith, do you know Michael Howe?
I know that name. Yeah.
Cross-Border Capital.
I know it loosely. I don't know him. I can't call him up.
So
I know Jack though.
Yeah.
You and I met Jack a few years ago. Remember that?
Yeah, that's right. Yeah, we did an interview, I think, with him. But so Michael Howell's kind of known as like the liquidity guy. So like he'll go on Macro Voices and Grant Williams podcasts and all that stuff. So he's just he came out in Jack Farley's interview and has a couple of great charts, but basically showing, the Fed's toolkit has created quote unquote stealth liquidity. So he's noting that he's, in his research and data is showing a rebound in the liquidity cycle, which he argues supports the new bull market. And he thinks quantitative easing is actually going to come back. And so, he's got a whole bunch of, basically long story short, he's got a whole bunch of liquidity measures showing that, despite interest rates still increasing, the Fed raising rates and whatnot, is that liquidity is actually increasing at the moment.
I mean, you have to view the Fed in the American market different than the Canadians and then the Brits and everything else. There's so many things going on behind the scenes. As you mentioned, is liquidity being provided to the commercial banks? Are they still lending to each other? Can the big funds borrow and lend without moving the needle? And then, of course, we have this, enormous shift going into private credit, so far this year. And if all of a sudden now we have all the central banks hiking rates again, we continue to, we don't hold any exposure to credit right now. So that's a strategy we have on deck. It's something we're going to be extremely excited to start allocating towards, but we think we'll get in at, 20-30% lower than where everything is right now. But you are right, Steve, like they're trying to slow down the economy, create a soft landing, and make sure all these, wheels behind the scene, keep moving around.
Rich, do you have any thoughts on that? Do you follow any sort of, global liquidity index, indicators, anything of that nature that's kind of flagged your radar?
Yeah, I do. I think that there's like one chart that it's been going around. It's basically plots the S&P 500 with that global and liquidity thing that you can find on the Bloomberg, and it's basically just tracked perfectly, and it makes me question what I do every morning and every day with my life, because it's just worked so well, and it's basically explained sort of all of the returns. Just to remind everybody, the price earnings ratio is going up. The earnings have been flat. And so people are just basically paying more for the same amount of earnings as those expectations get priced in. There's different ways to do liquidity. One way I learned at my old job was sort of doing the money supply relative to sort of industrial production, which was like one way to calculate liquidity. Another way to think about liquidity is also like, you loans, like the discount window. So a couple weeks ago, months ago, when everybody's worried about the SVB and all these regional banks, they all went to the discount window, and the Fed provided liquidity, and then you can see that number is coming down. But I would disagree with that gentleman. I can't remember what his name is, and we'll get into the Fed later. But yeah, so I think the issue, what I actually think they're going to do is probably accelerate QT, because what I think that they need to do is raise the long end of the curve. And you can see what's been happening today, which is, we'll get into it. Sorry for front running, but basically Powell said, we're not going to ever cut rates again, blah, blah, blah. Who knows? But I think in order to, and then you see the market reaction, I think in order to accelerate that long end of the curve going up, I think that they're going to accelerate QT. Remember when the Fed when all central banks changed their interest rate policy at the short end, and we know that the short end is sort of dislocated from mortgage rates, et cetera, et cetera. Anyways. And so that's I disagree with that guy. I think they're going to accelerate that tightening and quantitative tightening, and try to push up the long end of the curve, which will really, I think, accelerate what Keith's been talking about for a long time, which is slowing down credit growth, which is already happening, by the way, but further slowing it down and creating that reduction in liquidity.
So yeah, you and Michael Howe essentially be in complete odds of what he is sort of, I suppose, I think he's in style rather than substance, I would say. Right. Yeah, and that's fair. I mean, I think that's the whole point of having, a debate, is just to have two opposing views. I mean, that's kind of what makes a market, right? I mean, it's what makes it interesting. Exactly.
It's kind of interesting because what you just said, Powell indicated, we're not going to cut rates for a long, long time. It's just 3 years ago. Remember all the central banks?
Yeah, well, that was the joke.
We're never raising rates. So, it is a pendulum going back and forth. And we are, reaching this extreme moment here again, which I think is coming back to the bond market. I know, Steve, you're talking about the 3 and 5 year all the time, from a housing perspective for Canada. We look at the 10-year, of course, as the benchmark for the bond market. But in Canada, the 10-year has been, going back and forth from around 2.7 up to 3.5. That's where again, it's 3 times now. It's knocking that 3.5, 3.6 number over the last few months. So we're at the point where, we're either going to, the 10-year will just break out higher still. So anyone, because remember, the bond market now is down about 5% over the last couple of months. And that's because the 10-year moving up and down and spreads getting a little bit wider. But I think it goes back to this conversation. I know we introduced it a few quarters ago that, the reason the yield curve is inverted because there should be a recession coming. And I know for us as a firm, we went long duration about 4, maybe 5 months ago. And so that's the benefit from long-term rates going lower. But that's what we expected to happen based on a recession coming into play, or expectations that it would happen. And that was working now. Then about 3 weeks ago, I'm always a bit coy sometimes in the podcast about what we're doing for our clients, because they're our clients. We're going to manage their money first. But we actually reversed that trade about a few weeks ago to actually benefit from the bond market coming down in value and rates going higher. So now we're back to that pivotal point again, Rich. Are we going to get a recession? Is it coming? And the Canadians are saying, it ain't coming.
Right.
The Fed is saying, no way, that ain't coming. The Brits have gone from, we're going to have the worst economy, since Churchill was around, for other reasons, of course. And so now they're expecting there's going to be a booming economy. The Europeans, they don't see a downturn. So when you get everyone on one side of the boat lined up, then okay, maybe we actually will see something breaking here soon. So I'm not saying that we've changed our duration strategy yet, but we're no longer positioned for it because it just got overpriced a few weeks back.
Yeah, there's just a lot of volatility. I mean, speaking just on the rate side, yeah, Rich, you're of the view then basically that you think they're going to try to push the long end of the curve out. So basically, higher yields essentially, which I again very much could be possible. I think with the intention of doing that be like, hey, we need to break something.
I guess the problem is it's contradictory from the word go, right? So in abstract, why would bond yields go up? Bond yields would go up because, people are less worried about a recession, et cetera, right? They're less worried about weak growth, right? When growth slows, you buy bonds, you sell equities, right? This is like broad strokes here. Don't at me. I'm just saying. And so, or, I mean, you could be worried about inflation, or you could be worried about central bank policy rates. There's all these sort of secondary issues, but, it's tough, right? They're two sort of contradictory like arguments, right? If you think that bond yields if you think that the growth is going to be very poor and then you're going to have a recession, then you want to be buying bonds. So you want to buy the price goes up, yield goes down. And the opposite's true. If you're not so worried about growth, then you'll sell the bonds, price goes down, yields go up. So that's where, but this yield curve is completely unsustainable for banks. And we know that we've talked about the households and where they're sort of leveraged to and tied to, which is, not the front end. And I think that what the last 3 or 4 weeks has showed us is the Fed is very concerned about people pricing in cuts, and they want to shake that out. And so Keith mentioned, 3 years ago was about forward guidance, convincing every single person in the world that they're never going to raise rates ever again. And what happened is the expectations got pushed further and further and further out, and the yield curve sort of followed from their bully pulpit. And I sort of see the parallel now, which is they're saying, well, they're never going to cut rates ever again. And the opposite's now happening, where you have the yield curve starting to creep back higher to follow again that bully pulpit, that like forward. They're not calling it forward guidance, but that's basically what it is. And I think so you've got these two contrasting forces. I know that was a very kind of cumbersome answer, but that's sort of how I feel. That's exactly how I feel. Excuse me.
Yeah, it's interesting. I mean, speaking of rates and stuff, you've got, so as of right now, as of today, looks like the traders are pricing 2 more rate hikes from the Bank of Canada by October now.
It's funny how things change.
Crazy, right? I mean, what we were talking about, traders pricing in cuts, 4 weeks ago? I think we had 1 cut, 2 cuts this year. Now we're talking about 2 more hikes. So, I mean, obviously this can change with incoming data, but I always look at it and say, gosh, like, again, when the data changes, if we actually do get 2 more hikes, I mean, yeah, well, okay, what does that do to the housing market? Of course, it changes the trajectory. You'd be talking about variable rate mortgages with a 7 in front of it, which is crazy. I mean, 7% on a variable rate mortgage. That's what private lenders, you could have got a private loan, 18 months ago at 6%. So
private mean non 6 banks, you mean? Sorry.
Private being like, hey, Rich,
not my mom.
I need a mortgage. Can you give me some money?
Okay, cool. So like the big 6, not Maria Diaz. Right?
Yeah, exactly. But like I can tell you even on the B side here. So the B side would be like your Home Capital Group and your Home Capital and Equitable, basically. So they're like one below like the big banks. So basically, self-employed people, that sort of nature. So right now, if a borrower, so those loans are typically 1 to 2 year terms. They don't do like 5-year loans at these B lenders. So 1 year terms renewing today, they're roughly about 200 basis points higher. And if you took out a 2 year from a B lender, and you're renewing today, you're at about a 500 basis point increase.
Quick question: did those spreads go up or down over the last like 3 years or 2 years or whatever?
Yeah, they would have gone down, right? So
okay, the spreads have actually compressed. Interesting. Okay.
Well, What do you mean by that? Sorry.
Like, so sorry. So let me rephrase. So now it's 200 basis points. What a year ago
Oh
was
no,
it
no. So
100?
sorry. What I'm saying is like, okay, let's say you went to get a mortgage and you can't get approved at RBC, so you go to
Yeah.
a B lender because you're self-employed and you don't have a great
Yeah.
income tracker, whatever. So these B lenders, Home Capital Group, for example, will give you, let's say, a 2-year loan. They'll give you, say, so I don't know, would have been maybe 2 years ago, maybe have been 4%. And so today you're renewing, tack on 500 basis points to that.
Crazy. Okay, cool.
And what are they offering for similar GIC rates? Because they need to get the capital, to
Yeah, I
lend
think.
out.
Well, I mean, I know like they've got some promotions and stuff. It seems like they're advertising about 5% for like a 1-year fixed GIC, give or take.
Well, that's not too much higher than what the big six are offering.
Yeah. Well, I mean, I think the point being is that like I think you're just going to see this stress. Like, and people always say like, oh, how did housing go up in the spring? Like prices basically ripped back to all-time highs. Where's the money coming from? We have to understand like it was predominantly an inventory story, right? Like scarcity of new listings, people still need to transact. I still think, per the Bank of Canada's own research, is 1/3 of mortgages have seen a payment increase. So 2/3 of people have not been impacted.
Sorry, I just want to say, so in the UK, that story's blowing up. That is like front page news. So today, when Keith is gonna go through all the different central bank stuff, but like today, like that is like literally on the front page news that like our mortgage holder is gonna get screwed by this new interest rate because like in Canada, all those mortgage rates are sort of rolling over and getting refixed at much higher rates.
I want to get into that because like that's the big thing, right? Is like, okay, everybody in Canada has a variable rate mortgage has been triggered. Okay, so like now the banks again have distressed listings that would have come to market didn't come to market because most of the products are these fixed payment structures and they're basically just deferring everybody's interest. Their amortizations are blowing out, and like this is really not a problem unless and until if rates stay higher for a prolonged period of time. This becomes a much larger issue in the near term. Over the next 3, 6, 9 months, it's not really an issue, but as rates stay higher for longer, and that's the big question mark, it becomes a bigger story. And so, like I said, 1/3 of mortgages have seen a payment increase. So you still have 2/3 that haven't. And then you still have a whole bunch of homeowners, which I think in Canada is like 35% of people that own their primary residence are mortgage free. So you have a lot of the cohort of society that hasn't actually felt the full impact of these rate hikes. So I still think, great, the Bank of Canada wants to keep going, get it, totally fine. I personally think they're looking in the rearview mirror. These issues will show up, 12 months from now.
Keith?
I remember as well, so all of these central banks hiking rates, they're also talking to the commercial banks. So, I mean, obviously in the UK, this morning, they would have been chatting with the big guys there. And they asked them the question, hey, like, what happens with the book if we hike by 50 basis points? What happens if you do 25? What happens if expectations are for this? Or the yield curve does that? And so obviously they're hearing from the commercial banks that right now we're okay. We can absorb that. It's not going to be a big challenge for us. And that will give the central banks the green light to keep going. Again, like I think right now the central banks, they put up this big sign that says, hey, we're now desperate. We've been using all these pickup lines. Nothing's been working. They bring the economy lower. No one's listening. So, that's, we're, you guys watch Seinfeld? You guys never heard of that show?
Of course.
Yeah, a few years back. Yeah.
Love it.
But, the guy, George, he's one of my favorite guys on it. And, he was a hothead. And all of a sudden, then he'd say, we're going to bring it up a notch. And, that's what's happening now with the central banks. They're going to bring it up a notch until, they got to show if there is a horse named like Prickly Pete or something like that. And I just think we're in this incredibly amazing market. And I don't mean this in any way for anyone who's, they're struggling to buy a home or to sell this or that. Just from a pure global macro perspective, everything has now been synchronized once again. And it hasn't been synchronized so that we're going to relieve stress. We're going to create even more stress in the marketplace. Because if we were central bankers we'd be looking at this and say, you know what, we've gone 0 to 5%.
Nothing's
Everyone's
broken.
okay.
S&P is going to hit 4,500. The S&P is going to hit
Yeah,
4,500, man.
It's going to keep going. So they'll, we'll keep going with it here some more. And again, so it's, and the bond market will lead everything. The bond market was showing a recession because it was pricing in rate cuts coming up. The reason it was pricing in rate cuts was because it was the expectation we're going to have a recession. It's all connected here. Now, all of a sudden, the expectation is maybe we won't get a recession. So maybe, as Rich mentioned, maybe we do get this magical, Bigfoot riding a unicorn kind of economy. Yeah. And,
was it the Goldilocks, like soft landing? Is that what?
Yeah, something like that. But, maybe the whole world is going, is turning into Moab in a way.
Well,
But I love it. But from an investment perspective, the way it works in the bond market, everyone's always reaching for yield. Now they can pick up yield because rates have, come off from zero. But there's still a lot of people out there that are still stuck in the high yield bond world without even realizing they are. And when we do get another credit event happening, and depending on how big and strong and wide it is, it could create this like spectacular moment where, as a retail investor, you're going to be able to go in and you buy, one of the high yield bond funds, and it's going to be showing a yield of 14, 15%, something like that. All the private equity guys will be lining up, and then the pension funds and so forth. But that's one of the markets we have on our desk right now. We're not touching it at this point because we continue to believe that we are headed for a recession. It's going to come. It's getting pushed around a little bit. But if the central banks are desperate enough to break the economy, to bring inflation data down, they will do it. It's going to happen.
Well, can I interject just before you go on, Steve? I just think from my perspective, I agree, I guess, in part. But I think what's interesting is also just the complacency. So different ways that you measure complacency and stress are like the VIX volatility index, high yield bond spreads. So the spread over a similar duration corporate government bond. You have FX volatility. You have volatility indexes for bonds. You have implied volatility, which is just a math I don't understand. You have stress, interbank stress. You have CDS, so credit default swaps, all that. And then the dollar, you could argue, is a volatility. And all of those indexes and indices and measures are all sort of making fresh lows as credit starts to slow, rates get higher, the labor market is tightening. And that juxtaposition between sort of market complacency and a world where central banks are desperate to create a recession, I think is fascinating. Sorry, Steve, you wanted to say something?
Well, yeah, just on the central bank front, you're talking about the S&P, approaching those highs there, and like, same thing on like the housing front. I mean, we talked about it, I think it was like 3 or 4 months ago, and I had it on my show and stuff, but there was, a couple, reports coming out this year of, a lot of the sort of, I guess, market pumpers, but like, how housing in Canada, it's going to rebound, and then rates are going to get cut this summer. And it's like, yeah, but like if housing is accelerating higher and national housing data was going up 2% per month, if you start going 2% a month, well, okay, that's 24% a year. It's
24%.
Yeah, that's a big jump. Like, why, if you're the Bank of Canada, well, why would I be cutting rates? And so it was always kind of meet that sort of match. And so one of the things is the Bank of Canada actually published a couple of days ago. They published their meeting minutes. So I guess this is new for the BOC, trying to create transparency. The Fed does it. The Bank of Canada just started with this. So in their notes, that they say, well, part of our reason or decision to raise interest rates in June was, and I quote, they say, housing resale prices, which feed into the CPI with a 1-month lag, had increased for 3 consecutive months. So they flagged housing resale prices as one of the reasons they decided to raise rates. And so, the resiliency in the housing market ultimately, created its own demise.
Can I ask you a question? I didn't read it. Sorry, full disclosure. Did they mention anything to do with domestic demand or population growth or budget deficits? Did they mention budget deficits?
That's a good question. I don't know off the top of my head.
Sorry, I put you on the spot there.
I did kind of skim through it, and I was looking for the housing piece. And
sorry, I'm
so,
sorry. I didn't mean to
I mean,
put
that's
you
a
on the
great
spot.
question. I know that they have. I know they did mention consumer demand, like retail spending, which, to your point, obviously remains surprisingly resilient. I'm.
It's not surprising. I was so annoyed about that Bloomberg article. They sorry, for people who don't know, retail sales came in 1.1% month over month. That's tough to look at a monthly series for 40 million people, whatever. Of course it went up. We have huge population growth. What matters is per capita spending. But anyways, let's move on. Sorry.
I mean, and that's exactly my point. I just think, like, Keith, I'm curious your thoughts. I think there's like this narrative out there that, we're not in a recession. Everybody keeps talking about it and just never, it's not seeming to happen. The data is holding up. And I don't know. I just feel like anecdotally, like, I think a lot of Canadians are worse off and they're feeling it, right? They're going to the grocery store, they're paying off their variable rate mortgage or their home equity line, whatever they've got. I'm struggling to think like this resilient economy. It's just so strong. I don't really see it.
Yeah, I agree. I mean, it's, in every economy is always going to have a certain portion that are always doing well, no matter what. And there's always going to be a portion, it's always a bit of a grind and a struggle. But the aggregate data that's coming out and top down that the Bank of Canada is using, it's suggesting that things are okay. You know what I mean? It's not negative. So that's why they feel like, yeah, we can do this and do that to try to slow things down. But it's expensive. Like in these inflation numbers that we talk about, does it really matter what they are? It not really is the trend they're looking at. But you're trying to buy food these days, and you're like, okay, am I going to get the tomahawk steak, or am I going to go for the the pork cutlets? And it's a huge
Oscar
difference.
Mayer wieners.
Yeah, and so to answer your question, I think a lot of people are struggling quite a bit. People are working multiple jobs, working all day, and then they're driving a car at night and things like that, because the price of everything has gone up dramatically. And as everyone knows, if they do get inflation out of that, that unicorn number, 2% or whatever they want to get it to, it doesn't mean that prices are coming down. It means that it's not increasing enough. So yeah, see, but we have this economy now where headline numbers are telling everyone, hey, it's not bad. Everyone's working, everyone's buying, but underneath, I think it is a struggle, and that's why we are quite concerned, that something will come up. Of course, I think. Did you
see that? Sorry to interrupt you. Did you see that report from Costco CEO?
No, but this is important. Walmart, Costco, Kmart, these are all very important bellwethers.
Yeah, I mean, the CEO came out, I think it was a couple of weeks ago, basically noting that they're seeing in their sales data, customer preferences for meat selections changing. And they said
that's a big one.
Yeah, so we're seeing some switch to canned products like canned chicken, canned tuna, things like that. And they're changing. Yeah, he says historically, we've always seen, like within fresh protein, we've always seen when there's a recession, whether it was 99, 2000, 08, 09, 2010, we would see some sales penetration shift from beef to poultry to pork. And we've seen some of that now.
That's called the substitution effect.
Maybe that's a pickup line you can use.
Hey, baby, do you know what a substitution effect is? Yeah, it's the decrease in sales when a product is more expensive. People switch to cheaper alternatives. Very straightfhaird.
It actually means someone else. It actually means someone else besides you. Right? Yeah, it's a substitution. You'll go the other way.
Inflation hack. You just go and eat at Costco. You have the $1.50 hot dogs. They haven't changed in price in like 20 years.
So I think the other thing we need to realize is that it was 5 years ago yesterday that Greta Thunberg, is that her name?
Oh no, you're going down this path.
The young lady.
Oh boy.
Well, 5 years ago, she didn't suggest. She was quite specific that, if you don't, please stop.
You want me to read it for you?
Basically, yeah, read it out specifically. Then the world is going to end. Well, what is the quote, Steve? You can put it up on the screen as well.
She quotes, she says, a top climate scientist is warning that climate change will wipe out all of humanity unless we stop using fossil fuels over the next 5 years.
Okay, so here we are, 5 years plus 1 day. Still a few fossil fuels are being used up around here. So, like, some people interpret that as, oh, the world was going to end yesterday. But I sort of read it as we had 5 years to stop using them, and that hasn't happened. So
Coal
maybe
production
that's
just hit a
why.
record high.
Yeah, so maybe this is why, the central banks are just going to say, hey, screw it. The world's going to end anyway, and we're going to go hiking galore. People are still going to keep shopping and everything. But it's, it's one of these things where this, this young lady, she was taken advantage of. Maybe there's a prime minister at a very large Western world country has also been taken advantage of. We're going down these experimental roads with all this fiscal spending at the same time. I know I'm going off a little bit with the whole thing here, but
did you want to talk on Canada's oil production by 2050?
Well, tell us what the report says, and then I will weigh in.
Okay, I'll read it. It's from a CBC News article. Canada's oil output would plummet by 2050 in a net zero world, new modeling shows. So new modeling from the Canada Energy Regulator suggests Canadian oil production will plummet by 2050, and large portions of Alberta's oil sands facilities will be shut down if the world is successful in reaching net zero greenhouse gas emissions within that time. Essentially says that we're screwed.
Okay, well, that's not happening. Canada produces 4.6 million barrels of oil. We are the fourth largest producer of oil after US, Saudi, Russia. Fifth, I think, is China, and then sixth is Iran and Iraq. The global oil consumption is 100 million barrels of oil a year. 1 barrel is about 159 liters of oil. Sorry, excuse me. 100 million barrels per day. Sorry. That's a very, very important screw up that I did. 100 million barrels per day. 1 barrel of oil is 159 liters. That number is going up. The reason that number is going up is because 2 countries with the largest population centers in the world, so China with whatever 1.3 billion, and India, which I think has more people now than in China, or they will next year or whatever it is. So China consumes 15.5 million barrels of oil a day. India consumes 5 million barrels of a day. The US, for all people's misgivings, basically has consumed the same amount for years and years and years, and it's been quite flat. This is absolute nonsense, and people should really wrap their heads around the fact that oil is really, really here to stay. That being said, I saw some great stats on the renewable energy generation, which is, to its credit, growing at 15% compound annual growth rate. So wind generation, I think globally is around 2,000 terawatt hours. So just to give you an idea, so the US total terawatt consumption is about 4,200. So globally, wind generation is about half that. Solar's up to 1,500. And, so there is a huge push for solar power and renewables. I get all that. But the idea that we're just going to stop consuming oil, I think, is just gobbledygook. With any luck, we'll stop consuming coal.
But don't you think, it goes back to the Greta Thunberg, tweet that was, she had the world rage. Schools around the world were shut for the day. They go out and, parade and recognize what was happening. And now, years later, the whole thing is now deleted. It'll be conveniently forgotten about. And then we get another similar kind of headline news, which I think is irresponsible for this story to come out the way it is. So that theme, the whole theme about trying to crush oil, in that direction, because it affects us here in Canada dramatically. Because as you've discussed before, Rich, you look at what the net exports are for Canada, fixed capital investment and stuff like that. If you take oil away, we're done. It ain't going to be very positive for us here in Canada. But you continue to see these outrageous headline stories, and no one is allowed to call them on it. Or if they do, it's you're considered to be fringe and Moab and stuff like that. But I think we do need to realize and understand that oil is not going anywhere, and perhaps some of the greatest investment opportunities coming up, if they continue, will be in that space, that sort of stranded, asset space that's coming up. So I love the fact that, Steve, you and Rich are able to find these stories, continue to talk about it, bring it to the forefront. And then when the other side of it is, not working out, it is false. It's the duty of the media to call policymakers on it when they make a wrong headline story or they're going in the wrong direction. And we've had that pendulum really strong to one side over the last 5-8 years now. And I suggest it is probably going to move back the other direction.
It kind of feels like it is moving back.
Well,
I think it just swung so far in one direction. I think like it is, to me, it feels that way anyways.
Well, let's example. I tried to, I rented the car. So we started this trip in Las Vegas, because that's where you launch into Utah. Oh, I saw the Stanley Cup parade, by the way.
Cool.
Which is kind of interesting, because if you've ever been to Vegas, so the strip is just packed with people, and the strip is shut down, and the parade is going up, and there's thousands of people there, and there were probably a couple hundred hockey fans. They didn't care. They're still out there. They're
there for the party. Yeah.
Yeah, absolutely. They don't care what the party is, and it's there. But back to an example. You're going to rent a car, to start at one place, and we're dropping this off in Denver. And the car they keep trying to rent me was an e-vehicle, electric car. And I'm looking at this.
Boomer doesn't like that.
Well, you're going through Utah like for 9 hours in the desert. Like, you're not going to try to charge her. You don't see any other cars around.
Yeah,
so
that's a good point. I wouldn't. I have a Tesla, and I wouldn't roll the dice on that.
Guys, my battery might die here soon. Yeah.
You didn't bring your charger?
Yeah, I got to find it. We'll talk.
Unbelievable.
I'm going to get a plug and plug it in. You guys.
He's trying to get out of the podcast.
Well, I just think it's important that Canadians realize that. I'm very, very proud of Canada's welfare state, despite what people might think of my political leanings. I think it's important, and I think it should be well funded. If Canada did not have oil, given the debt to GDP ratios for non-financial corporations, households, and governments, given our lack of productivity growth, we would not be able to fund the generous welfare state that we are so lucky and privileged to have. This is just facts. And the idea that we can move away from this without spending on research and development is totally and absolutely bananas. I think the other thing that I would argue that people don't really want to admit is, US has been an incredible sort of example in how you reduce your global emissions. So in 2007, the US produced 6 billion metric tons of carbon dioxide every year. That number is down to 4.7. So let's say less than 20% decrease. This is while GDP per capita has risen, GDP has risen, the tech boom, all these wonderful economic variables have gone up. The way the US was able to lower their emissions while maintaining one of the most dynamic economies in the world was due to fracking and the exploitation of their natural gas resources. Natural gas produces 50 to 60, depending on your source, % less carbon emissions than coal. Natural gas killed coal. Thanks, Obama. What we're seeing in Europe is to be the antithesis of a logical and measured and realistic step to reduce emissions in the world. If you really, in abstract, cared about lowering emissions, you would be for exploiting natural gas resources to the extent that you were able to do so. Canada, I think, is the 15th largest reserves in the world. You can use tar sands and convert that into natural gas, and you would do everything in your power to exploit that natural gas resource and ship it to places like China. And in 2022, China built 102 coal power plants in 1 year. That's more than, I think, every other country in the world combined. And so, but what has the Netherlands done? They're about to mothball their largest natural gas field. What has the UK done? They've banned fracking and the exploitation of their natural gas resources. And Canada, I mean, Canada's refinery throughput is this 1.6 or 1.7, and that's the exact same number that it was in 1990. And so again, dogma and a lack of clarity with respect to the numbers affects what I think should be the goal, which is to lower emissions, and natural gas is part of that. And I think it's important that people recognize that. And you're right, Keith. People don't look at the data; they just parrot easy slogans, and I think those easy slogans will lead us, in my view, down down into hell or whatever. But I just, it's important that people get that natural gas killed coal. The U.S.'s emissions are lower because of natural gas. Fracking killed coal. Sorry.
Hey, Rich, why don't you explain why they're against natural gas? I don't think people may not realize why they're not willing to expand it further in some countries.
There's, I think, the broader view that fossil fuels must be stopped no matter what, which I think is, again, a completely insane and just detached from reality. They're not going away. Crude oil is super, super useful. And then there's a sort of the more narrow NIMBY view, which is worries about earthquakes and water and things. And the water bit, I get there are some real sensitive issues with respect to that. But I think that I mean, ultimately, that's the thing. This idea that under no circumstance can these countries produce fossil fuels, and they're doing the part. The reality is it doesn't matter what the Netherlands does. Climate change will be solved in Asia. And if we don't get China off coal, it does not matter what happens in Europe or in Canada or whatever. And the way that you can help China getting off coal is by retrofitting all of these coal power plants to burn natural gas, which is relatively easy from an engineering standpoint. And I don't know if I answered your question, Keith, but
isn't China trying to hold that kind of over like our heads or like the US heads of like, hey, you give me this or we won't, participate or accommodate to your, environmental goals?
Ultimately, it's the global, what people call the global South versus the global North, which is another euphemism. People don't like emerging and developing countries. They used to be called the third world and the first world. It's all the same things. It's rich countries versus poor countries, and poor countries are demanding that if you're not going to let Nigeria exploit its natural resources, I think Nigeria has one of the largest oil reserves in the world, well, then you need to pay them. Understandably so. I disagree. I don't think you can keep poor people from wanting to improve their lot in life. I think that's A, immoral, B, impossible, and C, counterproductive. I think the way that we're going to get out of this is through technology, through nuclear power, maybe through wind and through solar, but it's not helpful to lie to yourself. I don't think, whether you're an aspiring hockey player or a portfolio manager, whether you're out on the nightlife trying to find someone to love, lying to yourself is not an effective strategy to reach your goal. And if the goal is to lower emissions, then natural gas is part of that reality.
Yeah, it's interesting to see, from a larger, bigger picture perspective, how governments are getting involved in this now. And, certainly there's a lot of narratives, but you're seeing, we had, the Trudeau government, provide that large subsidy to Volkswagen for their battery power plants. And now we actually had, I think it was Ford today, received a $9.2 billion grant for an EV battery power plant in the US. So the US kind of ramping up, trying to, I guess, compete or outbid, the Canadians. But from that perspective, I find it interesting that, this comes back to sort of Russell Napier. What he's talked about is we're seeing this environment in now, which is this credit creation.
You've got to fix your sound, Steve. Sorry to interrupt you.
Yeah, government basically allocating credit and where they want to point capital to sort of pick the winners and losers, right? And obviously that's sort of trying to starve the oil and gas industry and promote sort of wind, solar, electric vehicles. So it kind of comes this overarching view of governments getting more sort of in the way, not only from federal deficit spending, so allocating to social programs, but to certain companies, and so it does create a very, very interesting environment moving forward. And certainly you can argue that a lot of government spending is of course has created inflation and higher interest rates, and so yeah, I think it creates a very interesting environment moving forward.
You left out ESG, of course, because it is wrapped up. I know we keep coming back to the same themes all the time, but again, everything is tied up together here. Here she was.
I have a different. I know we have to go soon, but I have a different view on this. I think the idea that governments kickstart programs is not in and of itself a bad thing. The space program, the space program. John F. Kennedy basically said on a lark, that thing, let's go to that big round cheese thing. Like the knock-on effects from an engineering, technological, computational, Tang, what is it called? Diapers. I mean, I'm joking, but there was incredible amounts of, positive knock-on effects that the government spending and directing government funds that cannot be underwritten by private companies were positive. Governments decided that they should do the Panama Canal. If it wasn't for the Panama Canal, that was basically subsidized and funded and underwritten by the American taxpayer, we would not have saved literally trillions of miles and money and whatever it is. So it's not Eisenhower building the interstate. I mean, or a government
Rich, you're on a good roll.
Always bad.
You're on a good roll.
I'm just saying it's not all bad. That's all I'm saying. It's not always bad.
Correct. I think though, but all these, big and wonderful, items that you just listed, they're all 1% correct. Those are projects that the private sector are just going to say, we just can't, we don't have the capital to do it. So that's where the government has to go in place. I think the struggle or the challenge today that governments are now extending their reach into markets where they shouldn't be. So for example, when they're directing banks that, hey, you should lend to this group, but not to that group. We need to make sure that this part of the economy is getting money and that part is not getting any money. And if anyone is talking about it online, then, we won't let that voice get heard. And that's the real challenge, is that
I think that was kind of like my overarching point, is more like they've kind of discovered the printing press more or less, and it's a slippery slope. So we'll kind of say, Rich, that kind of brings me to the point, I think, to kind of, as we get close to wrapping this up, but I'd be curious your thoughts just on, the UK today, the Bank of England raising rates 50 basis points, sort of surprising markets. Curious if you were surprised. And it's weird because I feel like, inflation clearly is coming down in most parts of the world, but it seems stickier in the UK. Like, it seems like you guys are still dealing with very, very elevated inflation.
So inflation in the UK has always been kind of higher for the last, let's say, 20 years or whatever. And I think that's probably right. I stole this from somebody online that I can't remember what their name is, so I apologize. I can't attribute it to him. But their argument was like, I think the Bank of England is like, quote unquote, front loading these increases, which is actually what you guys have said. I think, Steve, you mentioned this a couple of weeks ago, and I know Steve has said this, Keith has said this before, which is, why raise 25 basis points a month? You should raise it 1% or what have you, and just get it over with. And I think that's what the gentleman said on Twitter. I can't remember his damn name, but anyways, and I think that's really what they're doing. I mean, they, as Keith rightly stated months and months ago, maybe last year, they're trying to curb demand, and this is the way that they feel that they can do it. Unlike in the US, mortgage rates are attached to the front end of the curve. And I think genuinely raising rates will have a material impact on demand. And so is it right? Is it wrong? As Keith always tells us, it's not that important what you think should happen. It's what will happen.
What's happening with their housing market over there?
Year on year, it's down. But it's had a, year on year, it's down. I'm looking at it right now, 2% year on year. It's similar to here. I suppose it had a bit of a resurgence in the spring kind of thing. Yeah. But immigration's really strong. It's hilarious. Like, we don't talk about Brexit too much. one of the main reasons for Brexit was they wanted to lower immigration. That didn't happen at all. Immigration is the exact same. I'm laughing because it's just so ridiculous. But like, yeah, I mean, immigration to London is good. Rents are ripping in London, and we'll see. I think rates are going to go way back up in the UK, and they're gonna induce a recession, as Keith has, I think, rightly said for a year now. That's their goal.
Yeah, I mean, I guess just to kind of summarize, it's just been very, very surprising, not just in Canada, but in all parts of the world, that things are still kind of holding on. I mean, actually, Rich, to your point, it's interesting because like they basically kind of blew up the gilt market there for a little bit, and I suppose we've moved past that, and they're back on their rate hiking crusade.
Yeah, I can't speak to that. I think Keith has a better view of that kind of thing, but like, just because things
thoughts, Keith?
Yeah, Keith, tell us.
Tell us,
Tell you what.
old
Tell
man.
you what.
Tell us, Boomer. Educate us.
Well, once upon a time when I was a little boy, I don't know. I mean, the thing with the UK that's just so interesting, and the same with everywhere. We hang on every word from the central bankers because they're supposed to be this highly held group, and they are. We're entrusted them to make a lot of decisions. But what the Bank of England has done compared to all the other central banks, they've gone they've done a 180. They've gone from predicting a very severe recession is going to hit to now we're not even close. We're just going to grow too fast, create too much inflation. We're going to break that, and that's happened in about 9 months. I think is the time frame for it. So that tells me they don't have a clue what's going on. They're not being proactive. They're just merely reacting. And they've been a pretty dramatic move with it today with that 50 basis points hike. And again, just go back to, once again, central banks have synchronized, and they synchronize through their hiking rates. And markets are now that you have to react to that and adjust to it. And, we talked a little bit of a conversation here now about, what is the government getting into? What are they allowing to happen and not allowing to happen? Like I keep going back to the the American credit crisis or housing crisis back in 08, 09, in that period. And people, when I say what I'm going to say, people say, "Oh, you can't do that." But they should have let the losses occur around the world. And let's use Canada as an example here. They say, "Oh, you can't do that." I say, "Yeah." Just say the Canadian banks all went under, for example, and all of a sudden, the world said, well, you can't do that. There are losses. But I would say, I would maintain that if that happened on a Friday, on Monday morning, you would put up a sign and say, hey, we're going to open up 5 Canadian banking licenses. Who wants to apply? Make sure you have, several $100 billion in capital ready to go. The applications would have been filed by Tuesday morning. Like fresh capital would have come in, but policymakers today in the public sector, they don't want that to happen. They always want to continue to have no losses taking place because everything is combined. I mean, they all know each other and hang out. But that's the road we're going on now. They want to break something, but they want to break it and have losses occur anywhere. And it doesn't exist. So, it is this world with, the Bigfoots and unicorns and UFOs. That's the world they're trying to create. And
there's no free lunch.
They can do it.
There's no free lunch.
There's no free lunch. That's a good point.
MMT, free money.
Yeah.
All right. Well, I think that's a good place to wrap it up. Keith's been gracious with his time here on his vacation, getting away from all the unicorns and UFOs. So, as always, appreciate your guys' support. All we ask you, share this episode with at least one friend, family member. Give us a 5-star review, whatever. Leave us a comment in the Spotify, Apple, YouTube comments. Love to hear from you guys. Curious your thoughts, housing, inflation, etc. And as always, we'll see you next week.